In our next segment, we've looked at today's market. We've seen what's happened. Let's wrap the week. This is one of my favorite segments because we focus on the long term, right? So I've often mentioned, I keep pounding it away on the show, don't get too caught up in the short term, too caught up in the flickering ticks. If you're thinking long term, if you're thinking about your retirement account or a long-term investment strategy, you want to think about the short-term price action, but within the context of the longer-term trend. So if you've not heard me talk about the first thing you look at in the morning, look on YouTube, look for David Keller first thing in the morning, and you're going to see a chart kind of like this. I think one of the most important things you can do is start your day with the right chart. If you look at something too short-term, too intraday, too fluid, too noisy, you're going to get way too anxious with your investments. And you want to start with a proper long-term perspective. So this right here, folks, is the chart that I start with, which is a weekly chart of the S&P 500, and it's going back 5 years. So before I look at anything else, I remind myself, where are we at relative to the long-term trends? So until you get too excited about volatility, until you get too excited into the short-term themes from sectors and from ETFs and from small versus large cap and all the things we talk about, understand the long-term trend, which is undeniably positive, right? The chart is going up. The S&P 500 is above two long-term weekly moving averages. I'm using the 21 and 34 week exponential moving averages here. The PPO, which is more of a tactical read using the weekly chart, is positive. All signs in the green, and again, this is a trend-following device. It's not going to tell you, to be bearish until things really start to revert lower. But overall, let's just remember that the long-term trend has been positive. Next, let's look at a little bit of market breadth. So we've talked about this a number of different ways this week, but one of the charts I like to refer to is the S&P 500 daily chart here, and then the breadth line. So this is the cumulative advanced decline line for the S&P 500, for the mid-cap index, and then for the small-cap index. There's also the NYSE, which is a broader sort of large to mid-cap universe as well. So overall, all four of these are in the green. All four of these are positive. The small-cap breadth line came down and tested support. That was one of the things we looked at earlier in the week, but overall has held up okay. So if there's one takeaway in terms of wrapping up this week, I would say this divergence, this continuing divergence, with the large and the mid cap being the strongest, small cap not being as positive. I'm just looking at the slope of the advanced decline lines in the last month versus small cap, which is sort of sideways. To feel really positive about equities in general, you'd want to see the small cap breadth break to new highs like the large cap and mid cap ones have been doing. We haven't seen that yet, so it's sort of on the radar of things to be paying attention to. But overall, none of these negative, all of them still in a positive mode, and that's totally fine. Next, we're going to look at new highs and new lows. So this is the S&P 500 at the top. The bottom panel I'll focus your attention to. This is the new highs and new lows every day for the S&P 500. So how many stocks are at a new 52-week high each day? How many stocks are at a new 52-week low today? We don't really have today's bar on here yet. I would assume it's probably a little bit higher because of the fact that the market gapped higher. We had a lot of stocks appearing to break out. So we'll see how this looks. But one of the themes that I've been looking at over the last couple weeks is this divergence between the market going higher and less stocks making new 52-week highs. Now, the reason why that's not a raging sell signal by any stretch of the imagination is we've seen this play before, and each time, in the last two times at least, it's resolved higher. So we saw that in September. We saw that again in the end of October, where you had this divergence of higher highs in price, lower highs in this breadth reading, but each time the market actually ended up resolving higher. So overall, again, it's sort of something to pay attention to, but it's not something that is necessarily a climactically bad signal by any means, just the beginning of a divergence. I want to spend just a moment on this, and then we're going to continue on to a scooter report here. But I wanted to look at breadth in the form of the percent of stocks above their 250-day moving averages. So as the S&P 500 testing all-time highs, what percent of stocks are above their 200-day? 3 out of every 4 companies in the S&P currently above their 200-day moving average, 75%. Overall, that is very, very healthy. The challenge is that lines up very well with short-term tactical tops in the market going back for the last 12 months. So overall, we're at the point where the market has topped out before, but again, that is no guarantee that we will top out, because if you look in 2017, this went well above the 75% level and remained high there, and that was in 2017 in a raging bull market continuing pattern of breakouts. What's interesting here, though, is the percent of stocks above the 50-day, which is diverging a lot more clearly, because that's a much more of a short-term measure. So when things sell off very quickly, they'll go below the 50-day, but not necessarily through the 200-day moving average. You can see that's fluctuated, but has hovered around 65 to 70%. So you would certainly want to see that break higher, break above the previous levels, and that would sort of confirm a breakout in stocks. We have not quite seen that yet. That's something I'm going to be looking at. I want to switch to the scooter reports. So we're going to go here to the scooter reports page. I'm going to look at large cap stocks. I'm going to look at 1 week. And sorry for the change of mind, but I'm going to switch to U.S. industries. So we talk often about the industry changes, and we look at what industries have moved the most in the day. But at the end of the week, I like to take a step back and see what's fluctuated week to week. So if you remember, you changed the scooter report to a 1 week look back. That's going to give you a weekly read on what's happened, sort of a Friday to Friday period. So the top ranked industries: computer hardware, healthcare providers, home construction. This is home builders, right? Footwear, specialty finance. So a number of different sectors that are actually represented here. A couple in consumer discretionary, but the number one is in technology, and that's a group that's done very, very well. New intraday highs this week after a nice rally. But let's look at what's fluctuated the most. So on the upside, surprise, it's actually mining stocks. So if gold stocks, gold miners are not on your radar, boy, take a look at that group again, because if gold continues to appreciate, if that group tends to do well, it is so off people's radar because it's just not been an area you think of when the market's going to new highs. But gold miners up the most as an industry relative to others. Then we get into some other, water is actually a really interesting theme. That's a long-term thing I know a lot of individual investors are looking at, but the index itself actually one of the most improved. And then fixed line telecommunications. So what concerns me a little bit is when the market's testing new highs, some of these really conservative, what I think of as more risk-off industries have actually improved the most. At the bottom of there, we have heavy construction that's in the industrial sector. Look at that breaking to new lows on the little preview chart. Broadline retailers, and again, if you have one general group that's struggled, retail in general has been a little tougher place, but the broadline retailers actually rolling over. You're going to see a number of other groups within industrials, things like aerospace, trucking. Those are things that reflect on transports, which is why Dow theory has not been as attractive as other ways of slicing the market. So a number of interesting themes in here. Boy, when we wrap the week, I feel like I could spend an hour wrapping the week with you, but we need to move on, folks, to continue the